Time to start. Okay. So we'll start on this panel session, which is, I've entitled it sort of, Beyond Basic DD, which is obviously due diligence. So when you think about due diligence, you think about studying a company's projects, reviewing their press releases, looking at the insider ownership, the share structure, the previous financings, vetting the executives and the board members, going over the financials, reviewing the technical reports, feasibility studies, and other things, and meeting directly as you're doing here, talking with the companies directly. So that's kind of the basic due diligence. What I'm trying to get at here in beyond due diligence is, what are all the non-obvious tools, concepts, tips, and tricks that investors are most often learning the hard way, through buying companies and watching the stock price go down when you're like, well, this is good news. I don't understand it. So the questions I want to get into are, what investors need to pay extra attention to in technical reports, feasibility studies, and news releases, because these things, there's often stuff hiding in plain sight there. What factors contribute to a stock going down after the release of good news? Because it just doesn't make sense, but it happens so often. How do you figure out if management is really truly aligned with shareholders or not? What does a style of financing say about a company's prospects? What intelligence can you gather from how a company is set up? And what does the style of financing signal about a company's situation? So, we've got 3 people here today: Luke, Peter, and Brandon. Why don't you guys just quickly introduce yourselves, give a little bit more color on what you can bring to this panel.
Yeah, I'm Luc ten Have. I'm a private investor in this sector for about 12 years. Not affiliated to companies, just investing with my own money. And next to that, I've got a website/app called GoldDiscovery, where I try to, gather data and help investors make the right decisions.
Thanks for that app. I'm Piet Vanrusselt, so I'm also a private investor, Belgian one, following the sector for over 15 years, so I've seen the ups and downs also. And I'm here, I think the 3rd or the 4th time. I think it's important to keep showing up and keep meeting with the people and seeing if they keep their promises and if the people tell and do what they tell and the project advance. But I'm here as a private investor and same as investors here, looking to find the new and good opportunities.
Okay.
Brandon Macdonald, I'm CEO of Fireweed Metals. I'm a geologist by training. Spent a lot of time in the industry and spent some time as well in the City of London and the banking and mining finance side. So I come at due diligence perhaps a little bit different perspective, perhaps from the issuer perspective of what maybe not enough investors are looking at.
Okay, thanks a lot. So I just want to start out with a quick little story. I'm not going to get into too much of the details about it, but I had done my due diligence on this one particular company, and they were ticking every single box, in a good jurisdiction. They had a resource, that was already pretty decent. They had enough cash in the bank. They were doing drilling. There was absolutely everything. So I had a call, but except the one problem with it was that the stock price was just going down the whole time. They did an IPO at like $2.20, and when I was talking to the CEO, it was at $1 and had been on a downward trajectory. And I couldn't square what was going on. So I phoned up the CEO, we had a discussion, and he had a very simple answer about everything, that they got into a bad financing, and they were relentlessly selling, and the CEO basically told me exactly how long it would take for this to be done, so when to get back into the stock. And I was able to verify this information, through other means, that there was someone selling and there was someone else who was buying up all this stock. And as it turned out, he was exactly right. Stock started going back, and it's completely been the opposite chart to everybody else over the last 3 years. It's been sort of constantly going up from a low of about 50 cents to about $2.25 now. So it was a very easy way to make money, to invest in this company, if you went and did the extra mile to really figure out what was going on with the company. So that's what we'd like to sort of get into here. So question 1, there's a lot of important information put out in company news releases and various studies like feasibility things. What are some of the things that investors need to pay extra special attention to in these documents? And I wanted maybe Brandon to go over this first, because back, I guess last year at this time, Brandon came out with a news release that was basically telling people, we got something good coming, just be patient, it's going to come out. And if you can just get a little bit more into that situation.
Yeah, running a public company, you're bound by rules of disclosure, and it's in that particular instant, we were not putting out visual assays, we were not publishing core photos, but we did have in the table, in the appendix of every news release, a description of the holes we drilled to date, whether or not they'd hit anything, and a textural description. And people who had been following our news releases for a long time knew that feeder proximal meant high grade. And so when we described, I think, one particular hole last year as broad intersection of feeder proximal mineralization, a lot of people who bothered to read to the appendix figured out that was likely to be a pretty good hole, and it turned out to be our best ever hole in the project after years and years and years of drilling, right? So those breadcrumbs exist. Sometimes CEOs, they can't come out and necessarily beat you over the head with it, but they can put out a perfectly fine set of disclosure that for those who bother to read them all and piece them together can be hugely material, right? Now the challenge of that is that there's also lots of companies that put out visual descriptions of results, et cetera, for which the assays do not match, right? And that comes down to an understanding whether a company has a track record of under-promising or not, right? If they consistently over-promise, you should treat any visual description or breadcrumb with a giant grain of salt, right? If they consistently over-deliver, then those breadcrumbs can be a great ticket to a good return.
Yeah, exactly. So it's knowing the company, knowing what they're like. So when you see something that's very uncharacteristic, pay attention to that.
I don't want to make it a Fireweed promo, but I saw that and I bought on that news and I made good profit on that one.
But I did not. So why did you listen? You could have called me.
But it's like you say, if you read the news, you read the full news, but also go back to the previous one. Often companies say, okay, what's the drill program going to be? We're going to drill with 2 drills. We're going to do that many holes. Then you can see in that follow-up news release, I'm not talking specific here, but if they add a rig, that's nice. If they're already over the drill program in meters, that's also a tell that they're following up something.
Yeah.
Like you mentioned, visuals. If it's later in the program, they pretty much know if the core looks like this, it's going to be a good hit. If it's early stage, then I don't trust the visuals. So there's a bit of these tells that you have in the news releases that I want to add on this specific story.
And how about stuff like feasibility studies? Because most of the investors are not geologists, so they can't go into the big details. But what are the particular things that investors really need to pay attention to, like metal price assumptions and things like that? When a feasibility study comes out, and how can they, figure out, okay, is this thing real? Is it not? In a more simple way, I guess, in a way that a non-geologist can figure out. That can be.
Yeah. Well, I try to avoid studies, because how can you? Well, if you are a private investor without geological or mechanical engineers in your circle, how can you really figure out if this study stands out to other studies? Because you have to assume that not all studies are equal, right? Some companies are a little bit more aggressive in their assumptions. And of course, there's a qualifying person, being the judge, but still there's a difference in quality between different technical studies. And I do not feel qualified, or at least not being one of the best persons in analyzing these studies. So I'm not trying to take advantage of those because I know that there are many people that know way more than me about that topic. So I typically avoid them unless I already own a company and I don't want to sell it for some reason. and then I probably have to hire someone, or perhaps have to ask someone that I know to help me understand it. But I think the key is always try to understand as much as you can, because anything you don't understand is a sort of a risk.
Yeah.
So in terms of feasibility study, I kind of avoid them. But if you don't do that, try to really try to be one of the best informed investors on the street in general. And if it's about a study, same thing.
It's not easy.
Yeah, I would I'd add on top of that a full study may be pretty impenetrable to the average retail investor, but what you can go through, and what you're trying to understand is that, and let me tell you, from someone who's commissioned engineers to do studies, engineers can be very pliable. And what I mean by that is that there is a degree for which they'll be, a range of which they'll be comfortable in terms of assumptions, and the most aggressive management will push the engineers to the most aggressive end of the assumption for every input, right? So when we released our 2018 PA, one of our peers released one around the same time, and every one of their inputs was like 2 or 3% more aggressive than ours, right? And like a slightly higher zinc price, a slightly lower treatment charge, et cetera, et cetera, et cetera. It's, and all these things compounded, can end up in an IRR that is 10% higher, right? An NPV that is, $100 million more, right? So that is an easy place for a novice to start, because you can go through the peer studies and very much assumption for assumption, input for input, look at how aggressive was one company versus the rest. And odds are, if they're very aggressive on the defined assumptions, the clearly defined assumptions, they're probably equally aggressive, maybe more aggressive on the assumptions that are harder to figure out, right? Because it's like if I do an aggressive metal price input assumption, everyone knows right away. That's like right at the top of a news release announcing this. But some other stuff may be a little harder to tease out, right? So start with that, and trying to read through a feasibility study and scrutinize every bit of it. You don't have that much time, so you need to understand: do I want to trust this study? And two, what are the points in this study or this project that are likely to kill it, and focus in on those.
Nothing to add, but I'll add anyway. So, like you mentioned, we don't have time to go through all of these. So Control F is my friend also. You look for keywords, maybe not technical reports, but like warrants, risk. If you know there's a lake, you can search for lake, water, penalty elements. And because we don't have that much time, also I work with elimination. If you do two things, like very aggressive, you put a gold price of 2,000, that's not serious. If you take a discount rate in Africa for 5%, that's not serious. So if you have 2 or 3 of those that you say, can I trust the rest of this resource? It's pretty easy, well, not in the bin, but at least in the waiting room.
The only kind of counter I would say to that, the discount rate is kind of standardized at 5% for gold and silver projects,
but not for polymetallic.
Yeah, 7 or 8% for polymetallic or base metals, and these. If we look at what the interest rate is, the risk-free rate is now. We obviously understand those are ridiculous, but standardizing them allows quick comparison between studies, right? Because should I necessarily be deciding what the discount rate is for my project, right? That introduces another way that I can juice my project. So if you standardize it, it allows the investor to then modify it or apply a factor to it as appropriate.
That's also fair.
Interesting. One of the best videos I saw this year that I think everybody here should watch is one that Luke did with Antonio. And it was on investor expectations. And this gets into the whole idea of, great news comes out from a company and the stock just tanks off it, and why that happens. And that video really, you spent a lot of time getting into this idea of what expectations are already priced in and the importance of investors to try to figure that out. So is there any way that you can just summarize, some of your learnings from that, or open up that discussion?
Well, I think in general, if you are an early stage investor and you're waiting for a drill hole, of course, a company like Fireweed, I think, has a pretty good handle on the geology and on the deposit. So, and they, you have to know, what are they drilling for? Are they infilling or are they stepping out? And a company like Reunion Gold too. I mean, at some point they are far enough in the delineation process that they they still don't know exactly, but they have a good handle on where to drill. If you are really early in the discovery process, then the likelihood of them not immediately hitting something amazing is very, very high. Perhaps 95% if you take all the companies. So really hoping for a good result in a really early stage company is probably hoping, for something unreal, unless you get really lucky. So I always assume that the result is going to be bad, or at least not good enough for the market to excite. And that's why perhaps if you are investing before those drill holes and they are highly, highly anticipated, are you going in with a full position, or are you going in with a 50% position or 30%? And perhaps you can buy it way earlier than the crowd. Then you have a long waiting period, a boring period, where you just know nobody's buying because it will take a long time. But if you don't care waiting and you buy a stock at 5 cents and you feel like it could re-rate to a certain level before the drill program even, because once the drill program is announced, people say, oh wow, let's go there. There's a drill program. Results are coming. And that's actually when the risk is going up, because the likelihood of failure is getting closer. So that's, I think, by going to a site like CEO.ca, where you see a lot of retail people chatting with each other, you get a good sense what they expect. You go to Twitter and you look at what those retail people, mostly retail people, expect. And if everybody is very excited and hoping for the best, then it better be good. Otherwise, the thing will certainly tank. And on top of that, the volumes on the TSXV are extremely low. If you compare it to Australia, a similar type company, if you just look for two companies that look pretty similar in many respects, do the same thing, similar market cap, and you look at the volume traded per day, in Australia that could be 5 times higher. So in Canada, with a little bit of liquidity, it could go up, but also could go down. And if you're waiting for that drill hole and the bad news comes in, or at least lower than expectation, then for sure a little bit of selling volume could just push the stock down 30%, 40%. And if you're not ready for it, you could be really disappointed. So at least you should be prepared for that potential moment to come. I think, was that to what you are referring to? Or?
Yeah, well, also, because you're even doing stuff like, in order to gauge sentiment, or expectations, you're starting to use like some AI tools to sort of quickly analyze, like on a channel like CEO.ca, what the expectations are, and then using that in order to be able to say, okay, what's the general feeling here? And then using that to help gauge, okay, is this thing priced right now? Yeah. Is it overpriced?
Well, especially in a market like this, there are many companies with no attention at all. And then you need to really trust your own judgment, of course, and your own ability to evaluate projects if you really go early stage. And if you see that no one is talking about it, then the likelihood of expectation is also much lower. So if a stock went from a stock IPO'd in 2020, I mean, all these companies want to go to the stock exchange because the market was hot and everybody wanted to get his thing listed as soon as possible. And then the bad years came and they didn't get the good results. And stocks all went from 90 cents or 80 cents to 5 cents. But did that kill the story, or was just the market very bad? So right now you've got companies trading at 5 or 10 cents that were trading at 50 cents, 80 cents, and they still have some cash left from that period. Some companies are still 3 million cash, 4 million cash, and trading around those market caps. So if you look for those 10 companies, for example, and you just figure out there may be something here that's now trading at 4 million market cap, and people were willing to pay 40 million for it 2 years ago, 3 years ago, and if really nothing changed, or maybe something changed that is acceptable, well, then you have an opportunity, I think. And then you need to start digging, like, is it really an opportunity? How many people are still in the stock? You call the CEO. Who are your shareholders? And I mean, slowly but surely you get a good sense of what the company is like at that moment. And that's how I often found my opportunities, when nobody cared. There's no guarantee that a stock without attention is good, but it at least gives you, the expectation level is low, so it could not really disappoint anymore. And if you see a stock flatlining at some point, and there's no buying and selling anymore, then it's often a sign, not proof, but a sign that most of the sellers are done. Everybody who wanted out is out. It's not going much lower anymore. It's not going higher either. And then you could buy some stock in the market slowly, rather than waiting for the stock to double and then a financing follows. So a couple of things that I take into consideration when I look for really cheap opportunities. But that's more into the very small, high-risk plays, and it may be a little bit different for the advanced companies like Fireweed, for example.
Okay. Piet, yesterday you tweeted out a really interesting tweet. I easily spend 100+ hours on a previous conviction pick. It also turned out to be one of my biggest losses. The market doesn't hand out rewards for trying, but you get to take the learning experience home. I think this fits exactly into what we're trying to talk about today. You did 100+ hours on a company that didn't turn out the way you wanted to. Can you give us any insight into, what?
Well, I mentioned the name later, but I'll not mention it here again. But it was a copper story, and I learned a lot, of course, on copper properties and talking with the CEO. And I mentioned it last year when Philo was here. I used that experience to buy Philo pretty early, and then I made that money back on that story. So I used that learning just for the next opportunity. And like you say, you only learn when you lose. And if you win, then you think, of course, confirmation bias that you're doing well and
right.
You know what you can do, and you'll invest, I think, more easily in the next one and more easily get burned. But yeah, it's when you build that conviction, you also put in probably more money and more time. And then it's still exploration, so it's still, you don't have all the variables in your hands, so it's also.
So would you do the due diligence you did differently if you were going back? Like, was there some obvious things that you missed out on, or was it just the drill didn't play out as you were expecting?
Feedback from a good, let's say a mentor or a good friend, he said the story is too complex, so you're spending a lot of time and you're learning it, but who else is doing that work? And who is going to buy it from you in 1 year or 2 years? So it came that the story is pretty long and it takes a lot of money in copper properties to drill it off, and then you have some bad years of dilution. So yeah, you learn a lot about to look out for certain things.
Well, I think, detailed due diligence is fundamentally discipline, right? And the highest risk part of a project or company tends not to be the exciting bit, right? So it's like when we have some company that we're really excited by the geology or something like that, that's where we spend all our time, but that's not what's going to kill it, right? So being able to have the discipline to front load evaluating the risks, the key risks, before you super deep dive on the nuances of the opportunity, right? Because it's like the first bits of your due diligence is wild swings, and then you start to hone in on a concept, a thesis. You don't want to start by honing in while there's still wild swings to kind of go through, right? So that's I think what's required for most retail is having that discipline to back up from the thing that they find most interesting and look at the stuff that they don't find interesting, because that's where their blind spot is.
Right. Interesting. Okay. How about the importance of really knowing who the shareholders are and at what level they got in, i.e., who owns the cheap paper? Because another example that I have is I bought in, a company sold me on their story. They were doing the right kind of exploration. They had a great thesis. And then I bought into the company, and then they came out with this really promotional piece, you won't believe, one of those crazy headlines that you see and you go, oh my God. And I was really upset. Stock goes up 35%. I sold, and then I called up the company, really upset, going, what are you guys doing? You seem like legitimate players, this is a real thing, and why the heck would you, hire this terrible, promotion guy and spend all this money on this? And they actually told me something that was really quite interesting. They said, we did that for a very simple reason. We had a whole bunch of legacy shareholders because we wanted to give them a way out. And this is what we did, just to clean them out, give them an opportunity to get out. Now that they're out, we can get on with it. And you're going to see we're going to be back to the company that we're thinking there would be. And that's exactly what happened. The stock sold off a bit. I got back in, and then they had a big discovery hole. And it's been great since. But again, that's,
I would love to comment on that.
Yeah.
Because I work for shareholders, and so what you're doing there is you're actually doing a disservice to your new shareholders by driving the price up, over promoting, bringing in people who maybe don't understand the story, and you're doing that for people who are now no longer shareholders, right? So that is completely ass backwards, right? That's exactly what I would not want to do. And you know, Fireweed early in our we weren't even a year old. We ran a pretty aggressive promotional campaign, which I deeply regret because we overheated. We traded good shareholders because when you go up that fast, what happens is the solid, say I've got Piet as a shareholder. You're a shareholder, right?
Yeah.
Okay.
Partially.
If Piet sees some big promotional piece come up and the share price goes up too quick, he's going to go, this is too much too quick. He's going to sell his position. He's going to sell it to someone who doesn't understand what's going on. About a week later, that person who doesn't understand what's going on is going to be like, okay, what did I buy here? They're going to sell it. They're going to move on to the next shiny thing. Your share price is going to start to go down. Piet, meanwhile, is not buying back because he's moved on. He's got some other position he's traded into, and you enter a downtrend and you tank, right? So these kind of like feeding that sugar rush is hugely counterproductive, and I've never bought into this notion of like, well, we have to get these shareholders out. Yeah, well, then let them get out at a lower price. That is a gift to your new shareholders who are your new bosses. Right? So if someone wants out that bad, yeah, you go ahead and tank my market. I'm not running some BS promo piece for your benefit, right? We'll get a group together and we'll buy it off you cheaper, and we're all going to make more money. See you later, right?
Yeah, that's good.
But I think it's hard for retail investors to get all the nuances. Also, if you have the meetings here, every company has a good shareholder base. Huh?
Of course.
We all have a Crescat or a Willem or a RFC or a Barrick or a B2Gold or 5% Frank Gusta. Or
sticky shareholders.
Sticky ones, yeah. So it's hard to gauge, but you can see it on news releases, of course, because they're looking, if you have a bigger position and they want to exit, they can only use the 5 days a year when you have news and the volume is more than 1 million, for example. And it's not negative that they want out, it's just normal business. And sometimes the funds go broke or they have redemptions. So it's a good shareholder, but sometimes they're also forcing their hand to sell. So it's a bit tricky to, well, what Brandon's saying is a very good story, but on the other hand, it's also tricky and hard to gauge as a retail investor.
Yeah, and that's talk to the CEO, like you said. You know, he on that example, there was a clear reason why the shareholder was selling. We've had that happen before, where it wasn't personal and it wasn't about us. It had to do with where the fund was at, right? People who don't understand that, who don't talk to the CEO, are not getting that, because you can't put that in a news release. Like, hey, so-and-so is selling because of X. It's not something you can put in a news release or discuss in an interview, right? But you can, if someone phones you up, you can be like, yeah, look, they're getting redemptions. I don't got any choice. They got 6 months to exit. This is what's going to happen, right? So.
And you can use that, for example, Osino Resources, they specifically said we have one guy selling and relentless. Not looking at the price, and it tanked, 20% in a few weeks or more. And then you quickly saw volume dropped off, and then nobody knows what to do the first few days, and then you see a few upticks, and then starting to believe that it's coming back. So that was really an artificial drop. And the other side, I once sold, let's say, District Metals that I think 50% in one day on a promo piece in Germany. I said, Garrett, I like you, but I'm gonna sell it to these Germans, and maybe I'll buy it back, but I never did. Right. So it's tricky because you change your good loyal shareholders for fresh money, and maybe the good ones never come back. So.
Yeah, I have nothing to add to this. I found this a really odd example, to be honest, what this company did. And companies, it should be fairly easy. The basic principles are very easy, I think. You just want a company, preferably with a very clean share structure, not too many warrants, where they know where at least the majority of the shareholders are. That's ideal. I mean, if you have a couple of good, wealthy supporters, preferably. And not too many warrants, not too many funny instruments, just a clean structure with shares. It's difficult, it's easier to say than do. And a committed management team that owns stock, that buys stock every now and then, and they will find their project in typically. Of course, as an investor, you need to find your way in. I'm not the guy that wants to buy in the run-up, typically, or there needs to be some real game changer in terms of discovery hole or something. I think the best thing is also to accept not being part of many stories and just make sure that you are part of the story that you understand and try to profit from those things rather than running behind every hype. And some hype, like Hercules Silver, is not a hype, but it could become a little bit of a hype. And why buy right now until you see the real first set of results? So I have learned my lesson. I'm okay with missing out on things. I don't care at all. Sometimes it's a bit painful, but just focus on the ones you believe in and you really understand, and then your day will come. That's what I try to do.
Okay, well, we got through about 2 of my 5 vectors. We're done with time, which is perfectly fine. That's the way it should work. But thanks, everybody, for participating in this. I hope you guys learned something, and you can use that to your benefit in this crazy world.